Hi everyone, Sean Humphreys here. Welcome to All Things Retirement. Well, if you're beginning to think about setting up a registered retirement income fund from your RSP money, and you're wondering what kind of payment you can get from the account, then I think you'll find this video helpful. I'm going to take you to the online calculators that we have attached to our website. And by going through the calculator, there'll be some important planning principles and assumptions that you'll need to make when you're calculating the payments that will come from your registered retirement income fund. So let's just take a look at that. Now, before we get into the video on the calculator, if you're not a subscriber, make sure you hit the subscribe button. We're posting content all the time on various aspects of retirement income planning, financial planning, and overall wealth planning. And if you like this video, make sure you hit like. Now, what I'll do first of all is just take you to my website. So Asante Wealth Management, Humphreys Wealth Group. If you go to the Toolbox tab, it'll take you to various content, but right at the bottom here, you'll see our online calculator. So if you go to the online calculator, just click that, and it's going to take you to a mix of financial planning calculators. There's some great tools there, but the one that we're going to take a look at is the RRIF payment one. So let's take a look at that right now. So this calculator allows you to take a look at various payment amounts from your registered retirement income fund and give you an idea of how long your money will last based on different dollar amounts and assumptions around return from the portfolio. So let's look at each of the fields. So the first one is portfolio value, and you can see here we put in a value of $500,000 just for illustration purposes. Now, when are we going to start the RRIF? Well, we have age 71 there. Now, you have to RRIF all of your RSP capital by the time you hit age 71, so by December 31st of that year that you turn 71, you technically don't have to take your first payment until your 72nd year. We're going to end the RRIF at age 90, so we're going to assume that it doesn't matter past that point, that we'll be gone by age 90, so that's the basic assumption we're using there. And we're going to use spouse's age. Now, in this calculation, we're saying no, but why would you consider using your spouse's age in the calculation, which you can do? Well, if you're trying to minimize how much money comes out of the RRIF account each year, you can elect to use your spouse's age, and if your spouse is younger than you, it'll reduce the payments you have to take out, and I'll show that to you in a second. Spouse's age, we're using age 65 in this example. The rate of return we used in the portfolio, we're saying 4% per year on average. Again, you can put your own number there in terms of your assumptions. We're assuming that payments start in the second year. So again, what I said was the RRIF gets set up in your 71st year. We're going to take the first payment in our 72nd year when we have to take it. Type of payment is minimum. Okay, so when we take a look at the calculator, the value of the account, here it is $500,000, and our first payment comes out at age 72, and the annual payment will be $28,080. The withdrawal percentage is 5.4%. So the calculator will give you all that information. And then the ending value of the account after that year. So it's showing you the payments every single year in this page, and the percentage coming out, and the ending value each year. So keep in mind that minimum payment was $28,080. Let's go back to the top of the calculator. So let's see what happens if we use the spouse's age. So it's just over $28,000. We use spouse's age, should do the calculation for us. So it drops it from $28,000 to $21,685, or 4.17%. So the overall income that you have to take out has been reduced. Now, it's important to keep in mind that on these annual payments, if it's a RRIF minimum payment, there's no statutory requirement for the financial institution to hold back taxes. So you could give direction to the institution as to how much you want to hold back, or you could receive the payment and then remit the tax that's due through quarterly installments or through payments when you file your tax return. What I find most clients want is withholdings at each payment, kind of just like a pension check. So by the time they file their T1 filing, they basically remitted sufficient tax, and there's no surprises for them when they file their tax return each year. Okay, let's take a look at another assumption. So this assumption is somebody who's going to take more income every year and will take it earlier. So in this assumption, we're going to use age 60, and we'll leave the end date at age 90. And we're going to assume 4% returns again on the portfolio. And we're going to take income right away. So we're going to set up the RRIF account at age 60. And we're going to use a payment of $45,000 per year from the account. So we're going to go from $28,000 to $45,000. and the individual wants to see this income indexed at 1.5% each year to cope with a little bit of inflationary pressure. So what happens in this scenario? Well, you can see that the income payments go from $45,000 by age 71. They're up to $53,008. And you can see the ending balance in the portfolio is going down every year, a lot more pressure on the portfolio, so that by the time this individual hits age 71, if they kept drawing portfolio value at that rate, basically the portfolio is fully depleted at age 71. Again, depending on the client's circumstances, if you had a client that had other pensions, their government benefits, work pension, and they viewed their RRIF account as just another supplement for vacations and travel and extra discretionary expenses, then this may be a fine situation. And particularly with RRIF payments, you can income split 50% of the payment to your spouse after the age 65. That can reduce some of the tax bite. Now, once you do your assumptions, so this is a great tool to kind of play around a little bit in terms of what your income payments are going to be and how long the portfolio will last based on different assumptions around inflation and return. Then you can also print this off. So there's a print function. You can create a PDF document as well. So I'd encourage you to take a look at the calculators from our website. Just go to Humphrey's Wealth Group and you'll find the calculators under the Tools section. So one other thing I'll just bring you to your attention is under the Services tab. If you go down to Retirement Coaching, if you're getting close to retirement or already retired, I'd encourage you to go to our coaching page. In here are a whole bunch of great resources. There's a video that talks about a retirement coaching service, and then complementary tools, which include retirement planning checklist, retirement planning tips, a sample report of the kind of snapshots we do for retirement income planning, and then a link back to our YouTube channel as well. Anyway, I hope that you found this video helpful, and if you haven't subscribed yet, make sure you do that so you don't miss future content. And if you like the video, make sure you click like. All the best in your retirement income planning. You take care. Bye-bye.